it's shocking that nobody even looks at the commercial, right? Would you rather manage 10 year-over-year tenants or 3 or 4 long-term business owners as tenants? People are scared of retail. They think it's too hard, too expensive, and too risky. And yeah, there's a learning curve to it. In terms of risk, yeah, maybe it's a little bit more risky because you can endure longer vacancies, but the reward more than makes up with that, right? You can double the value of a property with a signature.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Hey everyone, this is Ted Patel, and welcome to this week's edition of Decoding Cashflow Podcast. I'm here with Ash Patel, who is a full-time commercial real estate investor and a managing partner of Invest Beyond Multifamily. After spending 15 years in corporate world and starting numerous business along the way, commercial real estate changed his trajectory of life. And since then, he's investing in non-residential commercial properties such as strip malls, warehouse, flex space, industrial lands, medical office buildings, and much more. He continues to speak at several industry events and is a host of longest running daily real estate podcast. You can guess which one. I won't take a name. Uh, so Ash, welcome to Decoding Cashflow. It's a pleasure having you on the.
Ted, the pleasure is mine. Thanks for having me.
All right. So Ash, before we dive deep into your niche, right, would you like to give our listeners a little bit background about yourself? Or how did you get started in real estate and what's your main focus as of now?
Yeah, typical immigrant upbringing, right? Parents were very strict, from India. I was born in New Jersey, but we grew up like we were born in India. So just incredibly strict parents. When I went to college, they told me my major is going to be IT because my older brother was an IT major as well. So for whatever
I'm an
reason, they
IT
thought,
major as well.
yeah. I mean, was that because of your parents?
Kind of, you can say that, it's
Yeah.
all about maybe peer pressure or,
Yeah, well, I wanted to go into marketing, and my parents nixed that. They told me I had to go into IT like my brother. So I hated computers, but I got a degree. It was a business degree in computer information systems, and I got into the corporate world. I had a job for 15 years where, in hindsight, I really hated going to work every day. I moved up the corporate ladder just because I know how to talk to the computer guys and the C-level execs, but I always had a side hustle because I knew I wasn't going to work for somebody forever. So I started a marketing company, web design company. I started a company that sold sports supplements, but I made the mistake of calling it AmazonSupplements.com. It wasn't a mistake. I did it on purpose. But, back then, I mean, this was 20 plus years ago, Amazon wasn't who they are now, and they didn't even sell sports supplements. So 1 year into business, we get a cease and desist from their attorneys. We had to shut the company down, turn over all of our intellectual property to them, and then they started selling sports supplements. But it was maybe about 15 years ago. I started an IT consulting company, and I left my corporate job. But my wife and I were paying a lot in taxes. We were both W-2 people for the longest time. And we'd go to our CPA every year and we'd say, hey, what can we do to offset our taxes? And the guy just grumbled and said, if you make it, you pay it. And I thought there had to be a better way. So I heard real estate was always a good way to offset taxes. Went out and bought a building, and this was a mixed use building in a college town. I had 4 college apartments above a grocery store. So one day I'm out there unclogging a tenant's toilet, and I look out the window. I could see the roof of the store. There was an HVAC company replacing rooftop units for the store. I went downstairs. I asked what's going on. The store owner told me that his AC went out. So they replaced the entire HVAC system. He spent $30,000 on my building. And as I'm walking out that day, he stops me and says, Ash, do you mind if we remodel the bathroom too? And I thought this was crazy. I've got residential tenants destroying my apartments, and my commercial tenants are adding value to it.
Yeah.
So I dropped everything I was doing, shut down my consulting company, and became a full-time commercial real estate investor. Just started small and worked my way up over the years.
And how many years this was? Like 15 years
About
ago?
15 years back, yeah.
Yeah, back. And then were you always keen to get into real estate, or it was just luck by chance? You found some good deal and got in there.
That's a good question. I probably wanted to get into real estate. I don't know if it was the right reasons. I wanted passive income, I guess, right? Like
Mm,
everybody else wants passive income.
yeah.
But I absolutely fell in love with it, and I would do it forever. I don't care how much money I have. If I won the lottery, I would still be a full-time commercial real estate investor. So I absolutely love everything about it, the people, the networks, getting deals done, rewarding investors, all the above, man. I absolutely love it.
And do you still work, pay attention to, or maybe focus on residential, or you're pure commercial as of now, 80%
No,
commercial or more
yeah.
focused on commercial?
Over the years, I've bought mixed use buildings, I've bought some residential,
Mhm.
and each one of those deals ended up just being a nightmare. I'm not good at dealing with residential tenants because anytime they give me a sob story, I fall for it. And I've had some professional tenants that know how to play the game, and I got taken advantage of a lot. In contrast to that, our tenants are business owners. They don't play games. If they can't pay rent, something is really wrong with their business, and it's usually the beginning of the end. So we self-manage almost all of our commercial properties, and it's such a pleasure dealing with our tenants. Matter of fact, before COVID, I used to do happy hours at my house for all of my commercial tenants once a quarter. And that's how
Wow.
much I love hanging out with these tenants, right? And no one would ever do that for residential, right?
It's true.
You're not inviting your
Yeah.
apartment tenants to your house. I mean, these guys, they all met my family. I've met theirs. Um, I love commercial real estate, and I think a big part of that is our tenants are high caliber business owners.
Yeah. And all the properties that you look into, are they within your area or outside of the state?
Yeah, good question. I started with local properties, but now we buy all over the Midwest and Southeast.
And how do you manage it if it is beyond your,
I've
your
got a
reach?
staff of two people. That's
Okay.
it.
All right.
And I've got two business partners, but there isn't much to managing commercial properties,
That's true.
right? So our portfolio today is probably around 30 million, and managing our properties takes very little time.
Yeah. Especially as you said, if it is a commercial real estate property, right? Business owners, they might be on a triple net lease. They take care of everything, including their real estate taxes. Anything breaks, goes out, they take care of it. You might hardly get a call on those kind of properties.
Yeah, we have a mix of
Mhm.
triple nets and gross leases and everything in between, right? But
Mhm.
something for your audience to understand is not all triple nets are equal. So if they see a property listed online, LoopNet, Crexy, and it says triple net, it doesn't mean it's what they're thinking. So you have to look for the words absolute triple net or zero landlord responsibilities, right? Brokers play a lot of games by throwing around triple net. And a lot of times they'll list a property as triple net, but replacements are the landlord's responsibility. So, for example, if an HVAC unit needs repair, tenant takes care of it. If it needs replacement, landlord takes care of it. Roof could be
Uh-huh.
the same way. But there's also provisions. Every lease is different in commercial. So you can have a triple net lease where the landlord is responsible for snow removal, landscaping, and all repairs, but they get reimbursed by the tenant, right? An absolute triple net is one where if there's any problems with HVAC, roof, the tenant takes care of it. Landlord never even hears about it. So not all triple nets are created equal.
When you view a residential commercial property, like a large multifamily properties, compared to, let's say, strip mall or, medical office building, what do you see as a pros and cons, like advantages
Yeah.
versus disadvantages?
All right. That's a great question. So right away, I think the management overhead, right? You have everybody in an apartment on 1 year leases. You have turning over of units where you have to go in, put some lipstick in it, freshen it up. Then you have on-site maintenance. So, when you get over 50 units, between maybe 50 and 70, there is a huge pain point where you can't afford a full-time leasing person, can't afford a full-time maintenance person. So there's a bit of pain on your way up to scaling multifamily. And just, the amount of problems and issues that you have to deal with, that would drive me up a wall. The benefits, again, to commercial is you don't have the turnover and you often don't have to freshen up units. In our leases, when a tenant leaves, it has to be rental ready, right? Not
Mhm.
just somewhat clean, rental ready, or they have to pay for it to make it rental ready. And again, they're business owners, so they're not trashing the place when they leave. The benefit of multifamily is it's a little bit safer in that you can always fill it. Just reduce the rent a little bit and you can fill it, right? With commercial, that's not always the case. You can endure some lengthy vacancies, but I'll tell you right now, in May of 2024, retail vacancy is the lowest it's ever been in history. It's never been lower. So retail is the healthiest it's ever been. Any one of our retail properties, even if they're full, we get calls from brokers saying, "Hey, I've got a tenant for you. I've got people that want to get in here." And it's the greatest asset class right now, and it has been for the last 15 years.
Mhm.
It's been trending with lower vacancy for 15 years.
A lower vacancy plus long-term lease, right? Normally business, they have at least like 3, 4, 5 uh, years lease.
Correct. So your turnover is
Yeah.
much less, right? There's less to deal with during turnovers. And then the other benefit is our tenants often add value to our space. So, a couple examples, we have a couple salons, and they weren't salon spaces when they first signed their leases. They were just white boxes or just a pretty rough building or office or retail spot that they got. And they've transformed these spaces. They've put in six figures of their own money, add lighting, trim, redid the flooring. They put in all the plumbing and electric for the salon
Yeah.
stations. So when this tenant leaves, we have an improved piece of property, right? So we can rent it out as a turnkey salon to the next tenant if they ever leave. The restaurants that we have are the same way, where in our leases, we write down if a restaurant tenant leaves, all of the equipment stays behind. So a lot of times they'll upgrade the equipment, they'll upgrade the fire suppression, the hood, and all of that has to stay behind. So if
Mhm.
our tenant ever fails or leaves or retires or sells their business, the next tenant gets an improved property that we can charge more money for.
Yep. And how do you manage on the rent increase? Because these are the long-term lease, right? And it would have a clause saying like, based on the inflation, it might go up 2%, 3%, compared to, non-residential, right? You can do a heavy value add and increase the rents 10, 15, 20%, 20%. How do you manage those kind of rent increase in these commercial properties?
Yeah, so a lot of our leases have built-in annual increases,
Okay.
right? Anywhere from 2 to 6% annual increases. But upon renewals, when when a tenant renews, there's a built-in renewal upcharge as well. So it
Okay.
might be every 5 years, there's a 10% increase in rent based on the renewal. And
Okay.
in terms of adding value, here's one of the key differences. So we have a strip mall that we just signed 37,000 square feet to a national tenant, and they're paying roughly $280,000 a year. All of that income goes to our bottom line because it's triple net. So they're paying the taxes, the insurance, the maintenance, and common area maintenance expenses as well. So they added $280,000 to our NOI, If you divide that by 0.088 cap, we added $3.7 million in value with one signature, one tenant.
Mhm.
You can't do that with residential, right?
That's true.
And back to your earlier question, I've made posts on this where I'll take a 10 unit apartment building that might be valued at 600,000, and then I'll take a similar $600,000 property very close by that maybe only has four commercial tenants. And I post on my social media, which one would you rather have? All of the apartment people, it's like, oh, I'd rather have the 10 units. And it's shocking that nobody even looks at the commercial, right? Would you rather manage 10 year over year tenants or three or four long-term business owners as tenants? People are scared of retail. They think it's too hard, too expensive, and too risky. And yeah, it's, there's a learning curve to it. In terms of risk, yeah, maybe it's a little bit more risky because you can endure longer vacancies, but the reward more than makes up with that, right? You
Yeah.
can double the value of a property with a signature. And a simple example of that is, you take just a regular block building with a metal roof, and it might be worth $200,000. If you get a Dollar General to sign a 10-year lease, it's now worth 1.4 million, right?
Yeah.
So it's the paper, it's the income stream that adds value to commercial real estate. And for anyone that thinks retail is risky, I'll tell you, the headlines don't help, right? Because all the clickbait headlines are the store closings. Toys R Us, Kmart, J.C. Penney, Rite Aid, Bed Bath and Beyond. That's what you see in the headlines. But if you Google retail store openings for 2024, Dollar General is opening 800 stores, Five Below 227, Burlington 140, and Warby Parker. Warby Parker started out as an online only
Yeah.
eyeglass store, right? They're
Yeah.
opening 40 brick and mortar stores. Aldi 126, Tractor Supply is adding 4 million square feet this year. And the list just goes on and on. So I don't know why more people don't look at retail investing, and you don't have to buy a $5 million strip mall. You can look at where you shop for the pizza place, the deli in your own neighborhood, right? The dog groomer, the eye doctor, and look at those little strip malls, the mom and pop strip malls. Often those things cash flow very, very well.
So let's talk about that, right? What are your main criterias to buy or invest in these commercial properties? Like, what are the main things that you look for? You
Cash on cash return. That's it.
cash in. Mhm.
Yeah. And it doesn't have to cash flow on day one. We've bought vacant buildings, we've done ground up developments, as long as we can add a massive amount of value. So there's times where if we buy something as negative cash flow, but we know through research and evidence that we can add a ton of value. So for example, we bought a vacant strip mall. It was vacant for 5 years, except for one tenant. It had a church in it. So somebody in a suburb of Atlanta built this beautiful strip mall, and for whatever reason, they only got one tenant in. And it was, around COVID time. So maybe that had a factor in that. But there was a church and 80% of the strip mall was vacant. We bought it for 2.3 million, but we did a ton of research on the surrounding area. We looked at all the retail in the area. Vacancy was very little. And we looked at the growth of the area, just a lot of metrics.
Mhm.
And we've held it for 2.5 years, bought it for 2.3 million. We're selling it for 8 million next year.
Awesome, man. That's quite a return.
It is,
Yeah.
but this wasn't, we weren't rolling the dice hoping that we can do the best. We knew based on the area and all the other metrics, we knew that we can add value to this. So when we bought it, it was losing money, right? And the reason we're waiting till next year is because we signed a lot of leases and the market has gone up so much that everybody's paying way below market. So next year, when these leases are up for renewal, we can get a lot more money, increase the bottom line, and sell it for what we want.
And this is a strip mall, right? Well, because you have been dealing in so many different kind of assets, warehouse. How do you, learn to underwrite all the different kind of assets?
I've just made every mistake you can imagine. So, I will look at anything non-residential, and if I can make money at it, I'll buy it, right? Including doing ground up development. But a lot of it was probably just being stupid when I was younger. And when I say younger, I don't think I started this till my mid 30s. But I would buy vacant buildings and just work as hard as I could to get them filled. And during that process, just learned a lot, right? So, you learn the nuances of each of these different asset classes. So, medical, for example, is great because restaurants often will struggle to pay their rent, and that's what usually kills them. So, they have to watch all of their expenses, their food cost, and they have to adjust based on demand.
Yeah.
You'll never meet a doctor who's struggling to pay their rent. It's such a small part of their expense structure because their revenue is so much higher. So if you have a medical tenant, it's rare that they're ever going to go out of business. But if they do, let's say you have a foot doctor or an eye doctor and they decide to move, close up shop, whatever, all you have to do is call a competing foot doctor or eye doctor and say, hey, this was a medical practice that was an optometrist office for 15 years. They're leaving. Do you want in? And they're going to jump on it because
Yeah.
all the surrounding patients are used to going there for their eye care or their
Yeah.
foot care. So it's easy to re-tenant medical space, right? And medical spaces trade at a lower cap rate, higher dollar amount. So they often command a higher sale price. Warehouse, industrial, those are great asset classes. Tenants are very easy, they're low maintenance. There's pros and cons to all these different asset classes, but all of them are way better than investing in residential.
All right. And out of these, which one are you more uh, attracted towards in the non-residential part as of
Right
now?
now, retail, because it is absolutely on fire,
Okay.
right? We've never seen it like it is now. There's no reason to have any vacancy if you've got a retail property in a decent area with a decent traffic count.
And what's the budget that you look forward to, like the price of the property, I would say.
I'll buy anything that I can make a lot of money at, but I have to be respectful of my time and my staff's time. So, for example, we're looking to buy a $200,000 restaurant building. It's a whole building with a fully equipped kitchen, and it's probably worth 400,000 or 500,000, right? But it's pretty turnkey, so it's not going to require any time from our staff or myself. Um, it comes down to how much effort do we have to put in for the return, right? Ideally, we like things in the $2 to $5 million range, but I'm not opposed to buying something for a couple 100,000 if we can
If it
make a
can
lot
make
of
money.
money.
Yeah. And how do you find these deals?
Oh, that's a great question. So we look for mismarketed, mispriced, or mismanaged deals. We look where no one else is looking. So residential realtors posting commercial deals is always great because they often misprice them. They don't know how to price commercial property, right? They know how to do pricing based on comps, but not NOI, not cap rate. Um, so residential realtors is good. If you see a for lease listing, call them up and say, hey, look, tell me about your building. Tell me about the space. I'm interested in buying. I don't want to lease it, right? And get the conversation started. Um, Referrals a lot. We don't rely on brokers because if a commercial broker is listing something, it's priced close to market.
Yeah.
We're not going to get a great deal that way. Go to bizbuysell.com where people are selling businesses and find out if there's any real estate involved that you can buy. So just think outside the box, right? I don't want to compete with everybody else and call a broker, get on LoopNet, get on Crexy. I want to find these unicorn deals where there's massive returns or they're mispriced.
Any part of it is a direct marketing or anything as such?
No,
No.
um, I know a few people that have tried that, right? And it hasn't yielded any positive results. So no,
Mhm. Just contact the owner directly, right?
yeah,
If you can.
it's just putting a lot of time into looking for deals
Yeah.
and training others to do the same.
Okay. And and how do you finance these real estate deals? Is it the same kind of same kind of structure for the residential properties, or a little different?
Yeah, that's a great question. Um, Most people are probably used to financing residential properties, right? Whether it's single family or multifamily. And for that, you just call a bunch of different banks or get a lending broker and get the best rate, get the best term sheet. Find out which bank has a sale on mortgages right now.
Yeah.
For commercial, it's all based on relationships because with any residential property, there's a secondary market. There's Fannie and Freddie, and they can buy and sell loans back and forth. A lot of your audience probably realizes this from, excuse me, if for their home mortgage, they may have had a mortgage from US Bank, and then a couple months later, it's Bank of America that's servicing it. So residential loans are bought and sold on a secondary market. There's no secondary market for commercial loans. They're mostly portfolio loans. So whichever bank does your loan holds that loan on their books for the life of the loan. So you have to build a relationship with these lenders. They have to believe in you and your deal. And then you develop a track record. So you get to a point where you can bring your bank any deal and they'll finance it because they know all about you, your track record, the deals that you've done, and the asset. Excuse me. Lending has become a little bit more challenging in the last year or so because different lenders have different appetites, right? Especially the ones that have multifamily on their books that are non-performing. They might be shy about lending on office or value add retail. If something's cash flowing very well, much easier to get a loan. But
Mm.
if you're doing ground up development or purchasing something that's negatively cash flowing, you've got to make sure your lender has the appetite for that.
Uh, Maybe for the negative cash flow, they might ask you to put more money down, right? Uh,
If you
or
don't have a track record, they will. They'll have you put money in escrow, or they'll maybe do, 60% LTV, loan
yeah.
to value. But we typically get 80 to 85% loan to value. So we only put down 15 to 20%. It's changed in the last year where if we if we do a deal with a newer lender, we might be at 25% down.
Okay. It's just because of the relationship that you have built with the banks.
Yeah,
They let you.
relationship, being sometimes being out of state and just their lending appetite these days.
Right. And now talking about the due diligence, right? For the commercial property, what are the things that you check before you buy or after you put it in contract?
Oh, there is a ridiculous amount of stuff that we have for due diligence. I'll try to pull up my list here, but it is, I bought a book one time called Due Diligence for Commercial Real Estate, and I was excited because I thought I could add to my list, and our list is about 3 times longer than what they have. I'll tell you some of the maybe out of the box things that we have. um, we will call the city, the county, anybody in local or state government, try to get grants, right? Try to get matching grants, facade grants, see if there's any free money available, TIF money.
Right.
But there's some overlaps with residential. We want tax returns, profit and loss statements, copies of leases, bank statements. Um, but we'll have to also do environmental.
Yeah.
We get on the local Facebook page, and not what town do you live in?
I'm in
Yeah,
Paramus, New Jersey.
Paramus. Okay. I grew up in Homedale, so not too far from you.
Oh, not too far. Yeah.
So Paramus has probably two real Facebook pages, one that's owned by the city of Paramus and one that is controlled by one of the residents. And the one that's controlled by the residents is where everybody goes to complain about the politicians, the police, the schools, the traffic, the prices, right?
Yeah.
That's the Facebook group that you want to get on. So no matter what town we're buying in, will always join that Facebook group, the neighborhood Facebook group, and we'll ask people questions. Hey, what do you think about this area? Is there a lot of crime here? We have some vacancy in this strip mall or this office building. What kind of tenant would the community like to see? And you'll hear things like, oh, we need a butcher shop or we need a pizza place. And matter of fact, call this person. We'd love to get them in here. And we reach out to the community, become part of the community. And that's a huge help, especially for filling vacancies and kind of winning hearts and minds, right? Especially when you go to small rural towns where everyone knows everybody. They're always asking, who bought that office building? Who bought that medical center? Who bought that strip mall? And you want to show up to a city council meeting and introduce yourself because when you need something from the city or need something from zoning, they're going to know who you are, right?
Yeah.
Introduce yourself to all the city council. Um, let them know what your plans are. Ask for their input, and this way, if there's any violations, they'll work with you. Um, so a lot of same out of the box things in due diligence.
Awesome. All right. So the other thing is, in our conversation, you mentioned there are there are certain things that you or maybe in other words, you have a group where you teach or how to uh, invest in these commercial real estate. I know you are running a mastermind also about the same. Would you like to give a little bit overview on that topic? Like what
Sure.
exactly
But
it
one more
is?
thing on due
Yeah.
diligence is
Yeah.
we also verify the guarantee of the tenant, right? So if we have, let's say, a Burger King
Mhm.
in one of our properties that we're buying, we want to find out if it's a franchise owner, an independent owner, or if it's a corporate deal. And if it's
Mhm.
corporate guaranteed, right? Because if it's a franchise, they can very well go out of business and you may not have a lot of recourse. If it's a corporate guarantee, you're fine.
Yeah.
Burger King's not going out of business anytime soon. In the same way, if it's a mom and pop business, you want to make sure that there's a personal guarantee in that lease. So they
Mhm.
can't just say, hey, I'm shutting down the business. Sorry, we're leaving. Right? If there's a personal guarantee, there's some teeth behind that lease. It's worth the paper it's written on. So in terms of the mastermind, after COVID, I had a few multifamily people reach out to me on Facebook and they said, Ash, we're getting killed because we have COVID tenants that are not paying. We live in tenant friendly law states where we can't evict them. So we also can't find any new deals because there's so much money chasing multifamily deals and they're overpaying for them. So nothing's penciling out. Can we talk to you about commercial? There's about 4 or 5 people. I got on a Zoom call with them, and 2 hours and 40 minutes later, I taught them how to get started, how to start underwriting deals. And they asked me, they said, how do we keep learning from you? And I said, I'm sorry, but I don't have the bandwidth to do that. I'm inundated with what I've got going on. They kept insisting. And next thing you know, we've got 20 people together. We started a mastermind. I took 20 people per year, or really per 8 months, and we did that 4 times. So we've got 80 people in our group, and that is the end of that group. So that group won't grow anymore. We'll continue to meet every Tuesday for 3 hours forever,
Mhm.
but we've also transitioned into a course. So we've got a course where you can learn everything I know about commercial real estate, from due diligence, finding deals, raising capital, filling vacancies, disposition, um, everything that I know. And we've got 80 people that we've had many of them quit their W-2s. They've become very successful. And this is not rocket science, right? I didn't do great in school. I'm not the smartest guy in the room, but this is just a great asset where we have so much less competition. So if you just go to investbeyondmultifamily.com, you can find out all about it.
Right. That's great, man. So Ash, just want to be mindful of your time, And I love this conversation, but I think we can keep going on and on for hours on these kind of topics. Uh, so would like to switch gears, move to the final round of questions. Is there anything else that you'd like to tell our listeners before we move to the final round of questions?
Yeah, just anybody who's that's hyper focused on one asset class, whether it's single family, multifamily, self storage, mobile home parks. There's so much out there in real estate. Look at what's making money, right? Right now, multifamily is not doing very well, but if it ever comes back, then transition to multifamily. Right now, retail, medical, industrial flex is hot. Why not transition into that? And if you become knowledgeable in all these different asset classes, they all ebb and flow with market cycles at different times. Industrial is usually the last to recover from a recession. And right now it's on fire. So I would encourage your listeners to look at all the asset classes in real estate.
Yeah, keep your options open everywhere.
Yep.
Okay, Ash, let's move to the final round of questions. Are you ready?
Let's go.
All right. So which is the one book that you'll recommend which had the most impact on your life or on your business?
Rocket Fuel. And the reason is I can't ever finish tasks, right? My desk is an absolute mess. I'll start 10 things, probably not finish most of them. And my whole life, I'm 48 years old. My whole life, I thought that was a negative until I read that book. And I realized that visionaries, that's a trait of a visionary. You have to have an integrator next to you that can finish those tasks, right? Your job is not to complete tasks, but set the tone, set the vision, and have others that can run with that.
I haven't gone through that book, but maybe I'll just put it on my list for sure.
Yeah, you look like you've got a clean desk though.
Not really. It's messy.
All right, then
Maybe
read
it's
the
not
book.
visible.
Read the book.
Yeah. Okay. What is the best business or investment advice you'd like to give to our listeners?
Just, no matter what it is, I invest in startups, restaurants, bars, tech companies, real estate. Use cash on cash as your metric for everything. That's it. It's very simple, right? If the stock market crashes, go all in on stocks, but look at your cash on cash return for any investment.
It's a great advice. What are your main source of information to learn and grow?
I think my network. So the more you interact with people in the same industry, there's no substitute for that. It's real world time knowledge. Had lunch with a commercial broker today, learned more about the market from him. So that can't replace books, newspapers, podcasts. I mean, just interact with people in the industry.
That's a great advice, sir. All right, Ash, one final question. How can Decoding Cashflow listeners get in touch with you?
My email address is ash, ASH, at investbeyondmultifamily.com. I'm on LinkedIn, Facebook. I do all my own social media, so I personally respond to any message or email.
All right. Thanks a lot, Ash. It was a pleasure talking to you, and thanks for taking time out for the show. It was a great podcast today.
You asked some great questions, so thank you.
Thanks for listening to Decoding Cashflow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cashflow, and we'll catch you in the next episode.